I'm Ben Reppond. Welcome to my YouTube broadcast. Today is October 11, 2023. I want to cover the story from last week. There were actually three things that were in my opinion, the highlights of last week. One was the jobs report, way exceeding expectations, and that was initially seen as very negative because what it meant, therefore, was the Fed was going to have to be more aggressive in raising interest rates. But the market shook that off. The second thing is that the war conflict in the Middle East and Israel was really, I think, dominated the news. And it didn't seem to, so far, have affected the markets in the U.S. and Europe. It certainly did in Israel. Israel's market is open on Sunday. That's a work day in Israel. And the market was down when I looked 6.7% in Israel on Sunday. And the other thing is interest rates. Interest rates continue to go up, and the talk of them going up is definitely there. They're removing the talk of interest rates going down, which would push bond prices up. That's kind of almost off the table. So it's like all they're talking about now is more rate increases, higher for longer. Higher for longer is the phrase. So I'm going to cover, yesterday I played a piece. I'm going to borrow that piece and play it today as the one thing I want to show you, and it's on interest rates. I think it's a blog. It's from Quick Take Asia. It's a news source, but I think it's not network news or that official, but it's well done. So I'm going to play you a clip from that because it covers a lot of the implications of bonds and does it in my opinion, a very factual way. So take a listen to this, and then from here, we'll go on into the dashboard.
Welcome to Asian Quick Take. I'm Jacob. In recent days, global financial markets have been rocked by a seismic event. Japan, one of the largest purchasers of U.S. bonds, has undertaken a massive sell-off of its holdings, amounting to approximately $900 billion in U.S. treasuries. This striking move has once again raised concerns about the economic prospects of the United States. Many experts now fear that the U.S. is teetering on the precipice of an economic recession and an impending debt crisis. This divestment action has also cast a glaring spotlight on the undeniable issue of U.S. debt, which has reached alarming levels. U.S. debt has surged beyond the staggering sum of $33 trillion, constituting a daunting 124% of the country's GDP. This situation has led to interest payments devouring over 35% of the total tax revenue collected by the U.S., a deeply concerning sign. Even with the U.S. Treasury's strenuous efforts to balance the budget and ensure that income matches expenditure, the annual deficit remains an imposing challenge, standing at a daunting $2 trillion. Let's now take a deeper dive into this issue, delving into its underlying causes and potential consequences. Since October 4th, U.S. Treasury yields have exhibited a relentless upward trajectory, with the 10-year Treasury yield briefly surging to 4.85%, marking a 16-year high. This has triggered widespread panic within the market, resulting in a pronounced wave of selling. This panic has been particularly intensified by the surge in trading volumes for bond futures, and a market that has sunk to new lows, further fueling the torrent of U.S. bond sell-offs. This unsettling phenomenon has unfolded against the backdrop of divergent perspectives within the Federal Reserve, comprising both hawkish and dovish voices, as well as Treasury Secretary Janet Yellen's backing of a sustained period of high interest rates. These factors have added fuel to the market's apprehensions about the Fed's ability to maintain its high interest rate policy. The turmoil in the U.S. bond market has also spilled over into other financial markets, including U.S. stocks, resulting in a market seemingly ensnared in an unyielding selling mode. As it stands, the US bond market is enshrouded in an aura of uncertainty, prompting institutions like the Bank of Japan to reconsider their positions on US bonds and their valuation.
Okay, let's look at a couple of dashboards. One is the stock market indexes through last Friday, October the 6th. In yellow, in the yellow box, are the results of last week among the 6 indexes, and in the pink box are the results year to date from those same 6 indexes. Last week you can see that the NASDAQ 100 was positive by 1.7%, S&P about 0.5%, all the others were negative, but when you get to the bottom two, the Russell 2000 down 2%, and of course the long-term government bond, which I've talked a lot about, down 4.4%. Bonds are getting hammered, and this one is getting hammered the most, but it's the one that also was used a lot during the last 40 years prior to 2020 when bond prices changed their trajectory and started going back up. So on the far right side, you can see that there's only 4 green dots, and what that means is in the top one is the NASDAQ 100. The NASDAQ 100 is above its 20, 100, and 200-day moving averages. It is below its 50-day moving average. And the S&P 500 is above its 200-day moving averages. Everything else is negative, below all of the moving averages. When we get to the sectors through last Friday, October the 6th, there were 5 out of 44 5 green dots out of 44 total potential. And those are the technology above the 20 and the 200-day moving average, consumer discretionary above the 200-day moving average, and energy above the 100 and 200-day. So, but energy is all over the place. It's been way up, it's been way down. It particularly has been way down. Last week it was down 5%. What was positive last week was technology and a little bit on healthcare. So year to date, you've got basically 2 sectors that are extremely positive, technology and consumer discretionary, a couple that are slightly positive, and everything else is negative or very negative. So the internal market, the core of the market outside of a few technology stocks, is not doing well. Didn't do well this past week, and has not done well year to date. So those few technology stocks are basically propping up the market. Okay, so here we are. The S&P 500 continues to move, generally speaking, in an upward trajectory since last October. So we've got about 12 months. This is an 18-month chart. So 12 months up and down, but generally speaking, moving in an upward direction. The last 4 weeks, the S&P 500 is still moving in a downward direction. Each of these are 1 day, and this shows that it's, going in a downward direction. Growth versus value. Now, since technology was up, you saw that, and the NASDAQ 100 was up, this should not surprise you that the far right of this chart is moving in an upward direction, showing that growth is outperforming value. So that's been true since the beginning of the year. Generally speaking, growth doing better than value. The S&P 500 is large companies, the 500 largest companies on the stock exchange, when in a weighted index. When compared to small companies, the Russell 2000 small cap ETF, IWM, when the S&P 500 SPY ETF compared to IWM. SPY is the numerator, IWM denominator. When it goes up, that favors large cap stocks. When it goes down, it favors small cap stocks. So you can see that large cap continues to outperform, small cap by quite a bit. So as you can see from that sharp rise at the end of the chart. Now we get to the damage, and this is the long-term government bond, which I've talked about, and here's what it looks like on the chart. So this just goes back to late 2021. If I took this all the way back to July of 2020, I could do that. You would see the longer-term trajectory goes back even further. So 3 years and 3 months of decline and still moving down. Now, people have thought, and even thought toward the end of last year, the first part of this year, that bonds were trying to go back up and bonds are going to, I won't say rally, but they will resume in an upward direction, and then they collapsed. And you can see that during the past several months. So this does not spell good news for traditional portfolios. So I showed you in the earlier in the indexes and the sectors, but you can see that a diversified portfolio is not going to just be in a few tech stocks that hold up the market. A diversified portfolio is going to be in a lot of sectors, including a lot of those that are losing money since the beginning of the year, and last year lost even more money. Last year was a big losing year for equities. And then when you combine that with this kind of loss for bonds, which are designed to hold up, to prop up the equity side of the market when stocks go down, I suspect, I don't have any traditional portfolios, I don't believe in that, but those that do, it's hard for me to believe that very many of them are going to be positive, and if they are, they're up by a tiny amount. Most of them, I suspect, because of this, and because most of equities are down for the year, I suspect that most portfolios are down for the year. But the traditional financial advisors are holding on to this. They're not giving up. I don't know how far bonds have got to go down, or stocks and bonds have got to go down before they, knock on wood and go, I got to do something different. But so far it looks like they're all bought into the idea for the next phase of the market. No matter where it goes, they're bought into the idea that stocks and bonds are the way to go to get growth and protect downside risk. You've got eyes, take a look. Okay, the dollar continues to go up and relative to other currencies. The dollar is under pressure. Of course, the treasuries are under pressure. Equities are under pressure. The U.S. economy is under pressure. But relative to other countries, which are in worse shape than us, our dollar in the short run is moving up. Gold continues to move down, so I put an arrow showing the general direction since May. It's in decline, and if you buy gold, again, that's put in traditional portfolios, not gold, but the ETF or mutual funds that have precious metals, again, putting pressure on traditional portfolios. And silver, the same thing, even more so. Now, you watch this, you know that I'm a believer in precious metals, particularly silver, and that I own them. I do not trade them. I do not buy them in paper form for this reason. I buy them as an insurance policy against the collapse, the eventual collapse or serious decline of the dollar. If that happens and we end up in some kind of you need some kind of currency. So if we end up in some kind of a barter system, I hope we don't, but if we do, I have something I can barter with. That's the way I look at precious metals. So I personally don't care if it goes up or down, because I have what I have. I'm not going to sell it. I'm not right now in a mode of buying more. Maybe if it drops a lot more, I will buy some more, but I'm not I'm not at this time, and that's not the reason I own them. So for those who trade them or those who are looking for buying opportunities, okay, that's why I show this chart. This is the relative strength chart. So it goes, this is showing if it goes up, it favors silver. If it goes down, it favors gold. So you can see that it is down. So silver, therefore, silver is down a little bit more than gold. Bitcoin continues to rise and slightly. And today, as of this recording, it's down. So we'll see. I don't think it doesn't seem like it's headed in a long-term rapid rising move like it's had in the past yet. But those who are strong believers believe that that is coming, maybe first quarter of next year. I don't know. But the market sometimes gets ahead of itself. So we may see that move before the first quarter of next year or before April, which is kind of when that target date is for the next move on Bitcoin. Volatility is kind of flat right now. It's up around 17. It was down around 13. So there is more volatility in the market, and the reason for that is that you can see that equity prices are down, therefore volatility goes up. Now I put the black mark in here to show that the mark around 24 is a generally agreed upon, you could say 24 or 25, but generally agreed upon number that if volatility goes up, particularly if it's rising as opposed to falling, but if it's rising and pushes above 24, that's a sign of increased volatility, usually a sign of decreasing equity prices, and in many cases a sign that it is going to continue in that direction. Asbury Research was negative for the last few weeks. Because of Friday being a positive day, it pulled one of the Asbury 6 indicators over to the positive side. So now you have 5 negative and 1 positive. Not enough to tilt the sentiment to positive. The cross-asset relative performance chart shows some things that are more favorable than others, relative strength, one compared to another. Stocks are stronger than bonds. Stocks are down, but last week, last month, last quarter, but down less than bonds. You've seen that. Large cap, stronger than small cap. Broad market, the S&P, stronger than the blue chips, the Dow Industrials. Growth is stronger than value. The U.S. is stronger than emerging markets. Emerging markets right now are pretty weak. And as I've looked at the data, the charts, the ETFs for emerging markets and developed markets, U.S. is stronger, but especially stronger than the emerging markets. Government bonds in the bottom section, fixed income, government bonds are stronger than corporate bonds. High yield is stronger than high quality, and short-term bonds are stronger, or less weak, I should say, less weak than long-term bonds. U.S. versus the world. Now, this is an interesting collection of countries. So when you look at the last 3 columns, the last week, the last month, the last quarter, and look at those that are in green boxes, you will see that the ones that are stronger than the U.S., and I think of this mixture of countries, New Zealand, the UK, Singapore, Taiwan, and India. That's a pretty interesting group of countries. The ones that where the U.S. is the strongest or stronger than are Chile, Brazil, Peru, Canada, Malaysia, Japan, and South Korea, and China and Thailand. So stronger than a lot of Asian countries especially, and some South American countries. Gold and silver. The spot price on gold has come down, so the spot price is $18.36 per ounce, down 4.8%, and you saw that on the chart where it was declining rapidly. And silver is down 8.4% to 21.69. This is the spot price. That's a gold-silver ratio. It went up from 83 to 1, gold over silver, to 89 to 1, definitely favoring silver as a better buy. The monster box, 500 silver rounds of silver bullion, virtually 100% pure silver, is $11,955. Remember a few months ago, several months ago, it was up over 14,000. That including the markup. The markup is $2.22, and the in the box of 500, that's $23.91 per ounce. And if you had just a sleeve or a tube, that would be a tube of 20, would be $24.41, slightly more because of the smaller quantity. And that is provided to me by my son, Preston Reppond. Thank you. Unrelenting inflation, recession knocking, sky-high interest rates, trillions of debt, dollars of debt, chaos in Washington, Taylor Swift, Travis Kelce. Tell me something positive. I'm positive we're screwed. Okay, that's what it looks like. I don't know what your news source is. I suspect they're all over the map. I read several news sources, and when I read it, I just shake my head. I couldn't even make this stuff up. It's pretty crazy. I'm not a negative person. I know you think I am, but I'm not negative. But I look at this realistically and try to think, you know, man, this is not a good picture. So where does it go from here? I really don't know. But it does, to me, it doesn't look very good. Thank you for watching. If you have questions or comments, leave them in the comment section below. And if you do like this video, feel free to appreciate you leaving a thumbs up, a like, and subscribe. That helps the distribution. I appreciate that. And thank you very much.